experts and get you a better sense of where the markets are headed, which themes are looking good right now. And to talk about all of that and much more, we have Mr. Rakshit Ranjan of Marcellus Investment Managers joining us on the show. And Rakshit, hi, good afternoon, and thanks so much for your time. First up, want to get a better understanding from you of where do you think our markets are headed, because we were kissing distance away from the Nifty all-time high just yesterday. Yes, a little bit of a consolidation today, but do you believe fundamentally the markets are now headed to move upwards given the strong earnings season we've seen?
Yeah, so fundamentally speaking, I think second quarter was about 7% earnings growth for Nifty compared to low single digits for the last 2 or 3 quarters. So to that extent, fundamental growth rate for the overall market has inched up a bit. Having said that, I think given where valuations currently stand, also given the sort of up cycle phase of business growth for many of the deep cyclical plays that we've had over the last 3 to 4 years, we expect earnings growth for Nifty overall to not exceed the long-term averages over the next 2-3 years. So maybe high single digit is what the broader market, particularly Nifty 50, might be looking like doing in terms of earnings growth. And within that, I think there are a bunch of sectors which have become more attractive relative to others in the last 3-4 years. That's where our focus is as a fund as well. But there are several sectors which have gone on a massive upcycle in the last 3-4 years, where valuations look very unattractive right now.
Mr. Ranjan, afternoon. Ashesha this side. And since you're talking about several opportunities in the market, which are those? Can you throw some light on those?
So I would say that the two types. One is in our fund, we've got healthcare as a long-term structural play, where it's not so much a cyclical aspect. We just think penetration-based growth for let's say hospitals, diagnostics, or some of the health insurance players. Penetration-based growth over the next 5 to 10 years is expected to be healthy, and business models are yet to fully develop to offer good value to various stakeholders. On the other side, I would say things like consumption, autos, auto anchs, beneficiaries of GST cuts, or the shift in government spending as well, and government policy from government capex more towards helping boost consumption. I think those are some of the areas where we've increased exposure over the last 12 months opportunistically.
Okay, and other than this, Rakshit, on the other side, if you could tell us some sectors that you are cautious about right now, that you are maybe underweight on or avoiding right now?
Yeah, so as I said, several of the deep cyclicals which have gone through a massive upcycle in the last 3-4 years, we are avoiding. Besides that, even I would say when it comes to lenders, which is banks and NBFCs, we have reduced. We are still exposed, but we are less exposed than where we were 1 to 2 years ago. Because we expect, barring some support from net interest margin expansion for the banks, we don't expect credit growth rates and loan book growth to be delivering significantly positive surprises in the near term, and hence I would say those are the areas where we are less exposed than we used to be.
Okay. India-US trade deal, meanwhile, continues to be a big trigger for the market. Do you think the market has perhaps priced in? And what, in your expectation, has the market priced in? Do you think India expects 25% tariff to come through as and when the deal is finalized?
I mean, looking at how the markets have behaved in the last few months or last couple of quarters, despite at best mid-single digit earnings, despite valuations being high, there is a possibility that some of that is already priced in. But having said that, I think there remain quite a few export-led fundamental-based opportunities, which in pharma we are playing one of them, in autos we are playing a couple of them, where it's more about export to Europe. US is an add-on, not the core area. So on and so forth. I think those continue to remain attractive from a fundamental perspective.
Okay, and Rakshit, what about your view on consumption? It could be staples, discretionary, retail, or autos, even for that matter, given that we are now seeing the normalization post the GST cut. Your take on the sector?
Well, I think two factors to be considered when it comes to implication of GST. One is price elasticity of demand, and the second is penetration rate or penetration levels of the particular industry in the broader population. So when it comes to staples, I think penetration levels are high enough for GST to be a significantly positive trigger, we believe. So at the margin, yes, premiumization will be benefited even in staples, maybe, but not so much overall in terms of revenue growth. But when it comes to discretionary, we expect better benefits from the tax cuts. Autos are very price elastic when it comes to the demand, and hence there is both volume growth as well as premiumization, which we expect to see in two-wheelers, four-wheelers, tractors, so on and so forth. Not so much in heavy commercial vehicles as yet, but yeah, those would be the areas: discretionary consumption, retail a little bit, and maybe auto and some of auto anchors as a relation to that.
Okay, so that's as far as the consumption sector is concerned. Since you briefly told us, Mr. Ranjan, that Indian valuations continue to remain expensive, in that backdrop, do you believe FIIs will hold on from entering into Indian equity markets for some more time, or do you expect them to start buying yet again now that the earnings outlook looks much better?
No, to be very honest, we don't understand all the factors that would go into FII flows. There are too many besides valuation. Geopolitics is a big one. Relative attractiveness of India versus other EMs is another one. So it remains, I would say, an area where as long-term investors, we don't think it's a big enough factor. From a short-term perspective, we don't understand the factor well enough.
Okay. And lastly, one really interesting sector right now has been the real estate space. Yes, the post-COVID boom was there and it settled down for a bit. And right now we're seeing some exuberance coming back. Do you like the space right now, or do you believe that it has already seen the run-up it was supposed to see, and now maybe it could be subdued in the near term?
I mean, let me put it this way: compared to a decade ago or a decade and a half ago, where balance sheet health was a concern for us in this sector. Compared to that, today there are a few companies where balance sheet is not a concern for sure in our minds. So to that extent, yes, we have some of those stocks in our broader research coverage. But when it comes to current attractiveness, there are mixed signals at the moment, not very clear signals of an upcycle from a demand perspective. And hence, given where valuations stand again for some of these real estate players, we're a little cautious.
Okay, so that's the view coming in on the real estate sector as well. Mr. Ranjan, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the fundamental outlook on the market is at this point in time. Thanks so much for joining us today. On that note, we need to slip into a very short break, but we will continue our coverage on the markets on the other side. Don't go anywhere.